Yo, what's up, everyone? Basically, what I want to show you is how I look for my trades and the market structure that I'm looking for during my trades. Um, I'm gonna kind of break down everything from like where the idea even comes from to how you can find it on the actual candlestick chart. Um, but yeah, without further ado, let's get into it. I just thought it was a good idea to get back on here and kind of teach y'all some knowledge because I haven't posted on YouTube other than like a trade recap in a while. So, market structure and market has been kind of weird recently. So, I think it'd be a good refresher for the both of us seeing what market should look like, or not should look like, but what we or what I look for in the market to take a trade. So, there's two main things that play into this. The first thing is a high time frame. We got high time frame um price action. And so what that means is that will be mainly on like the 4 hour or the 1 hour depending on what you like to trade. Um and then so there's high time frame, and then with high time frame there's also low time frame. Um, and these two go together very well because basically, um, here, I'll even do this. Where's this button at? Yeah, here. Another thing to remember though is high time frame holds more power. And the reason why I'm saying that is because whenever we get into the actual chart, I will show you the two correlating. And so the whole idea of this market, it's called the market maker buy or sell model. And so what that means is basically you're waiting for price to reach buy or sell side of the curve to enter the trade. And what buy and sell side of the curve is, and I'll explain that real quick, is that we see that price is supposed to move like this, right? This is how market trends. You don't want to be in not a trending market because then you can get chopped up. Uh, but when you're in a trending market, you're making higher highs and higher lows, right? When you're making these higher highs and higher lows, one thing that um, is happening is let's look a little bit closer, and this is what I mean is that let's say this is the high time frame, and within the high time frame there are little moves right here, right? We have the high time frame right here, and then compared to the low time frame, it's gonna look like this on the lower time frame, right? We're gonna have a little bit more highs and lows, right? But what's gonna happen is you're gonna see the same type of trend in the market, and that's what we're trying to look for is the difference of trends. And so this is really bad, but um, we see that we are in somewhat of a trending market to the upside. I know this is really bad drawing, might be super complicated, but the whole idea is that we're going up, but we're making higher. There's more price action happening on the lower time frame because there's just more candles. And so the idea is that you want to find on the higher time frame the reversal on the higher time frame. And what a reversal looks like is just when price like goes reverses in the direction. And so basically what that looks like with buy side and the sell side of the curve is that this would be the sell side of the curve, right? Because we're going down. But then this would be the buy side of the curve. I'm sorry the curves are like hella freaky right now, but um, that's basically the idea. And then on the lower time frame, it looks a little bit weirder, but the reason why it's important on the lower time frame is because uh, on the lower time frame, there's liquidity, and liquidity is what will actually drive price to do what it wants to do. Um, but the idea is to get down here, like this, after liquidity is taken out, and then target the highs, and then maybe some other highs externally, this way. But yeah, that's pretty much it, sell side and buy side broken down, and then of course you can just reverse it. Like, let's say we're in a like a not a bearish market right here. Let's say we're in a bearish market. This right here would be buy side of the curve, and you would want to wait for buy side of the curve to get formed, and then once you see that we start getting a reversal, which I'll teach you how we can start kind of seeing that, is when we'll see actually buy side or sell side of the curve be like the main objective one. And so yeah, let's get right into it on the line charts. Basically, this is really like, take a screenshot of this. I think this is really, really good. This is basically all you need to really understand when market's gonna reverse. And yeah, so take a screenshot of this. But I'll explain to you why this is like literally so perfect. So one thing I want to point out is that, remember, we have buy side and sell side of the curve, which we can point out right here. This is sell side of the curve right here because we're going down, and then buy side of the curve, we are going up here. So that is that is buy side and sell side of the curve. And then what I also want to point out here is that on the higher time frame, I want to show you that we're going like this, right? This is what it looks like on the higher time frame. Is just one continuous move. But on the lower time frame, we have all these highs and lows that I will tell you why they're so important. So basically, three things that price does is it searches out equilibrium, searches out imbalances, and it searches out liquidity. And if we know that, then we can pretty much pair that up with the buy side and sell side of the curve to basically find when price is going to reverse. And so the whole idea here is that we are in a bullish market, right? We got a big displacement, right? This might look well, I'll show you what this looks like on the charts, but it's pretty easy to find. You're just like, okay, we're really, really pushed up here. And what price will want to do is it'll want to retrace into equilibrium here. Let me actually, and this isn't in really any particular order, but it usually happens like this. Okay. Um, so now that we have these planned out, we see that equilibrium basically is like a discount zone. So think of like this entire zone right here just being all in discount. And the way that you can kind of think about that is that, like, price is going up. And so let's say if people up here, like let's say you get to the market here and you want to buy, you don't want to buy up here. And the reason why is because let's say it goes up a little bit more, but then crashes down, you're going to be in a bad spot for your leverage to actually make profit. So what many of the banks do at institutions, and what people do, you see like on Black Friday, like whenever the prices are cut in half, like people will run to the stores and fight each other, and that's basically what happens in equilibrium, is that price is looking so good, and so the banks, institutions, all the retail traders will try to get in because price is lower, and sometimes it can like fake out people thinking price is going to continue lower instead of return higher. And so basically that's equilibrium. And then liquidity is just resting over any high, any low, right? And so we see here that we have all these highs and lows is just liquidity, right? Buy side liquidity on the highs, sell side liquidity on the lows, right? And the whole thing about the market maker buy and sell model is that once we tap into once we tap into equilibrium, fill in an imbalance, which I'll get into in a sec, and then tap in liquidity, we have all this resting liquidity above us, right? That price is just going to want to go and attack. And so the whole idea is that on the way down, if you're on the way down, the whole idea is that you're generating buy side liquidity for price to later return to and take out. And then vice versa, if we're going down, the buy side of the curve would be generating sell side. So, and we'll kind of see it here. We see that we have sell side down here, sell side down here, sell side down here, more sell side here that we take out, and then sell side here, right? So we have all the sell side that we take out here, but because we're in equilibrium of the range, we don't really have to, price doesn't need to go any lower to return higher. And so another confluence that you can use, sorry, I know that I'm talking a lot, but this is really, really important that y'all kind of understand the reason why behind the market maker buy and sell model, because if you can understand the reason why, then it'll help you better understand it on the market. And then when we get into the charts, you can actually see it for yourself. And I'm not pointing it out for you. So we can see that price returns into equilibrium, check. Price sweeps out sell side liquidity, right? We sweep out the sell side liquidity right here. And then as we sweep it out, we tap into an imbalance. And this imbalance will probably be a fair value gap, or it could be a BPR. But basically, the whole idea of this imbalance is that you want to make sure whatever if you're trying to buy, then you want to make sure that the fair value gap is bullish for this example, right? Like whatever the fair value gap is, that's what you're expecting the trend to be. So let's say we're going bearish, then we would want to see a bearish fair value gap to get tapped in and respected, right? Because if we see that respected confluence happen, then we have very good bias that price will respect that and continue its trend. So we see that we tap into the fair value gap, and again with it's literally the same thing. You can zoom in even lower and try to wait, but that's not really what I'm not trying to teach you how to enter off of this. I'm just trying to teach you how to find this, and then you guys can form your own entries off of it. But we see here that we get a tap into the fair value gap, respect it well. And the reason that we can tell that we respect it is because we have a confirming confluence after, right? And the confirming confluence is this market structure shift right here. Once we get a market structure shift, then we have like pretty much confirmation that price has reversed this trend and is going to continue the trend that it reversed into. So bullish here, because you see that we are bearish. And one thing that I will say about market structure shift is it's a confirming confluence, which means that you can't really use it without any other confluences, right? So if we didn't just sweep sell side and tap into this fair value gap, if we got a market structure shift, I really wouldn't want to see the entry off of it because we haven't achieved the other, goals. And then after that, I guess this is kind of the entry, but the idea is that once we start respecting, or once we get the market structure shift, then this fair value gap will start getting respected, right? Because if you're in a bullish trend, then your bullish fair value gaps and all your bullish confluences should be respected. And then same thing with bearish. If you're in a bearish trend, then all your bearish confluences should be respected. So the idea here is that we tap into this fair value gap, and then we continue to expand off of that. And this is what I'm saying about like time frames, is that if we zoom in here, this little move right here could also be sell side and buy side of the curve, and we just have to find the internal market structure shift, right? like maybe there's a little market structure shift right here, right? And then retrace into another little tiny fair value. You know what I'm saying? But it's things like that that it's like the fractability and also how important it is to use higher and lower time frames when it comes to this model. Because if you just try to enter off a fair value gap, it might get stopped out. It might run a little bit lower and then continue. So it's all about confirming that the reversal is happening. And so, yeah, like I said, price needs to retrace into equilibrium first. Want to see it retrace into equilibrium first, into an imbalance. Then you want to see the imbalance get respected. How do you? Oh, sorry. You sweep out liquidity in an imbalance. Once you see that imbalance get respected, how do you see that imbalance get respected? Because we get a market structure shift right after. After the market structure shift, you want to see that fair value gap get respected because it should, because we're now reverse trends, and the fair value gap that is created on the new trend should be respected. If not, then manipulation your file, right? But that's it. Yeah. Now let's get into the actual candlesticks. Yeah, let's get into it. See it actually happen on the candlesticks. So we see here that this is pretty much exactly what I just showed you here. If you can't really see that, maybe I don't know what to tell you, right? But it is okay because I am going to try to explain it. So we see that here we get a big expansion. Why? Because on the higher time frame, price looks like this, right? We're coming down, going up, boom, right? And then we're coming back up. And then that's when we make a lower low, and then we kind of start reversing, right? That right there is what we were just talking about the equilibrium. So now we see that equilibrium is formed, right? We want to see price retrace into equilibrium. And then right here, what else do we see? We see that there's sell side in a fair value gap, right? And in this fair value gap, sorry. In this fair value gap, we get a respect of the fair value gap that's in equilibrium after sweeping liquidity. That's like the trifecta. That's what I want to get in your brains, that if we see this, then there's a good chance of a reversal. And then what happens right after a market structure shift? Once we get the market structure shift, then we're pretty much just waiting for price to, we see that we create this fair value gap, we tap into this fair value gap and respect it. That's just like, that's basically all I'm trying to say. And then like, look at this fair value gap that's bearish. Right after we respect this one, we disrespect this one, right? You know what I'm saying? We close out above it, and then that's pretty good. Another good confirmation that we are gonna want to continue higher. And then see, we have buy side just resting above for price to take. Like, all of this is very, very good buy side for price to just want to come up and take out after generating it, right? Because that's the main thing, is that you want to see that this is generated liquidity. Once you see that we're like generating all this liquidity, then we can expect price to want to come up after doing the things that I talked about. And last but not least, about the sell side, we see that we swept out the sell side, but what was the sell side created to? This was its own little range with this price leg right here, right? We get a retracement down into here, and then we start chopping. Literally, we don't sweep out any of the highs here or here, just chopping within. And then what happens? We finally get a manipulation out of this high, and then we just retrace back into that range. That's pretty much it. I would love if you had any questions, I would love to answer them in the comments. But yeah, that's pretty much it. I know that I wasn't really talking about entries, but I guess the whole idea is that like you enter off the fair value gap because you expected it to get inverse, or once we get this inverse, you can enter off the inverse and just continue higher. But the idea and the reason why I sometimes don't really understand other people trading is because um I don't know how exact they think um like of their stop loss, if that makes sense. Like I'm not speaking about every trader, I'm just speaking about some that just that are entering without knowing that that was going to be the end one. And this is actually a pretty good example right here. Wait, um, I'll go back to that, but we see that we on the higher time frame we can get the market structure shift, right, retracement into equilibrium. But then look at this right here, guys. If we know that we're in a bullish trend, right, on a higher time frame, come down to this low, to this high, right? What do? We tap into equilibrium. What is there? A higher time frame fair value gap. There's another confluence right here that is good. Tap into this. I'm just for y'all. I'm gonna do this. I don't even know if I could. This is April. I probably can't even zoom back into that. Here, let's go to the 15 minute maybe. I just want to show you that this happens literally on every time frame, and this is what I'm saying. So we see that it just happened on the higher time frame. Boom, market structure shift, right? Fair value gap. Boom. You see coming in next day. Boom. What do we do? What do we do? Boom. We tap into this, sweep out this sell side, right? We swept out the sell side. We have this buy side above. All right. All right. So now that we see that we're in this huge price range, we're in a bullish momentum, right? And then we have this buy side above us. And then we also created this buy side right here. We tap into equilibrium, tap into a fair value gap. We see that we even respect like this one. We tap into, we literally perfectly wick into it. Oh, there's a BPR. Yeah. BPR, which is a fire confluence. We see that we tap into that really, really nicely. And then what happens? We see it happens on the 15-minute boom. We get a market structure shift, and then what happens in the market structure shift? We tap into this fair value gap, enter off the fair value gap, and yep, like I mean, continue up higher. And that's what I'm saying. Like it literally happens on every time frame. This would be buy side of the curve or sell side of the curve right here, and then this would be buy side. What are we doing here? Generating liquidity. What are we doing here? Taking it out. What are we doing right here? We're rebalancing and waiting for confirmation of a reversal. That's it. Thank y'all for watching. Damn, that was a good video, I think. I hope y'all enjoyed it.